Welcome to our Leaders in Housing Counseling call. We've got a special call today around student debt issues that I know are pretty close to everybody's work. So we're going to get started right away. Got a few updates that we want to do. I think what we'll do is we'll initially have a we'll talk quickly about the, we'll actually do a quick intro to our newest staff person, very exciting, and then I'll do some updates on our legislative work and work with the administration, with the new Biden administration. And we'll spend most of the call with our friends from Student Debt Crisis and from Savvy, and they will give us an update on where things are at on the latest on student debt, on student loans, and what our strategies should be, as well as some ideas about what might be in the future that could help improve people's situations. And of course, featuring Savvy's tool, which is just a terrific tool to help people figure out what their where they stand and what they need to do in terms of student loans. So, and then we'll quickly close out with a membership piece, but let me start it all off with saying that I'm really pleased to say that Latika Wesley has joined our staff this week, and she comes from Home Free USA and has done work with NAACP and with a number of federal agencies. She's got a terrific background to this, and she's going to be doing our congressional work. So Latika, just here's your chance to say a few words.
Thank you so much, Bruce. Thank you to everyone who's on the call right now. My name is Latika Wesley. I am excited to be the new Policy and Program Director at NHRC. I actually got my start in the industry at Home Free USA, learning about the cycle of homeownership, and I'm happy to support nonprofits who are doing the frontline work it takes to become a homeowner, to keep your home, rental assistance, disaster recovery, all the things that help our economy become better for everyone. So I'm grateful to be here, and I look forward to doing more great work.
So expect to start getting emails from her, and we'll talk a tiny bit about what's coming up, but please be really responsive, because she's a major component in our campaign to get more funding for your programs in Congress. So looking forward to it. Thanks a lot. So let me dive in. And I'm going to start really with the updates, Ellie. So let's go to the next slide. So we had a very interesting meeting with the appropriations staff at in the House, and they've been always supportive of our work. And we teamed up with Andy Buchek, who we've had on these calls. He's a lobbyist for Green Path and also does work with the Coalition for HUD Intermediaries. We thought we'd do the conversation together. And, the conversation is really about, well, what's the biggest number we could ask for? And I usually started out with a line, let's be bold because of the need and because the opportunity and the great work people are doing. And so that's how we came up with a $65 million figure last year. And this year, they were open to us going for $100 million. This is a really valuable connection, and we are going to, that's the number we're going to work with. We have a little bit of groundwork to do in the Senate on it, but I think we will probably, I'm pretty encouraged by the initial response. And so that's going to be the push. Latika will certainly be working this in the halls of Congress. We will ask you at different times to do sign-on letters. We'll ask you to, some of you, when we have key meetings, to ask you from, with your senator or with your representative, we may ask you to join the call. And these are really important. When they hear the voices of people in the field doing the good work you're doing, and the rural counties, the neighborhoods, and in the middle of the city, the places where people, where the elected officials all understand is their base, those conversations really get elevated, and the fact that and really deliver in your community. So please be totally responsive when you get these, because it's really valuable and also builds your reputation. So there'll be plenty more to come on that, and there'll be another sign-on letter sometime in the next week or two that we'll start rolling out. And we're working actually right now on each. And the way it works on the appropriations process is that the people who are on the appropriations committee have direct access to what the budget making is, but everybody else obviously wants to have input. And so it's done through a formal process, which is an appropriations request letter. And each representative and each senator can write to their respective committees, and our committee is the THUD committee, Transportation HUD. And so we're going to do a whole push to try to get our representatives to add housing counseling at $100 million onto their letter. And we've done this in previous years and gotten some real traction. And we'll push out a notice just asking you all to reach out to your people. We'll give you some wording to use, and please do this. It's a major part of the process in terms of getting funding into the budget to show that there's support among House and Senate members. So that's all to come. We've talked before about the Black Homeownership Collaborative, and this is a broad collaborative that the National Housing Conference and NAREB put together. There's a number of you have been involved in some of the calls. Bailey Childress and Simone Griffin are co-chairs along with me for the Housing Counseling work stream and the Down Payment Assistance work stream. And we're working on trying to get this into something that will be in legislation and will get support from the administration. And so there's a conversation right now going on, particularly around down payment assistance. And we've kind of sized it up as trying to get $4 billion a year for the next 10 years. And that we've been arguing that housing counseling should be a requirement. It might be incentived rather than required. Given the politics of the situation, we will see how that goes. We'll continue to push to try to have it a requirement. There's a lot of people to see, and there's a question about what our capacity is to deliver on that, and that's partly what we're trying to work on right now. But there would be funding specifically for this program, substantial funding in the program design for housing counseling and for down payment assistance. We're pitching grants of up to $20,000 and potentially also bump up for particularly underserved populations. We'll see where it all lands, but we're getting a very warm reception. There'll be a separate conversation in the Senate. This one's in the House with the House Financial Services Committee. We know that they're very interested in moving something. And there's also a very interesting conversation going on that's led by the National Fair Housing Alliance and Center for Responsible Lending, two good friends of ours. And it's about how to effectively target programs like DPA so that they actually deliver to the underserved, especially Black and Brown home buyers. And given the loss, the erosion we've had, especially in Black home ownership, this is sort of recognized by everybody in the administration, or most of the administration, and a lot of people in House and Senate about being a key piece. And so they're working on a more targeted approach that isn't just income. Income doesn't seem to really deliver that well in the communities we are talking about, and geography hasn't been as good at targeting. And I think there'll probably be some program that's really aimed specifically at first generation home buyers, so people whose parents weren't homeowners, and that might get some special attention in this. A lot more to come on this, but I'm just sort of telling you that's kind of a work in progress, and hopefully in 6 or 8 months there'll be a program getting set up that would be a major down payment assistance. We're very clear that in some markets $20,000 is not enough. It's a lot of money in some places, but not in every place. And in high cost markets, this would be stackable with other existing down payment assistance programs. So a lot more to come on that, but just wanted to let you know about it. Built into the $1.9 trillion stimulus bill, we talked about this 2 weeks ago. There's $100 million for COVID-19 housing counseling and $10 billion for the Homeowner Assistance Fund. Homeowner Assistance Fund is aimed at people who are in forbearance and coming out of it to help them with past bills that they might not be able to afford to pay back, as well as for hopefully doing some write-downs to bring their mortgage payments down to a more affordable level if their incomes haven't been completely restored yet. We had a meeting, we're part of a broad coalition with the Americans for Financial Reform and National Consumer Law Center kind of being the lead, but a lot of us have been deeply involved with it. We met with Treasury let's see, that was on Tuesday, and it turns out we had very high level people from Treasury. It was actually a very high quality meeting. Our argument is that this program should be very streamlined and not replicate some of the problems that a lot of you have talked to us about hardest hit funds, and learn from that experience. So money would flow from Treasury to state housing finance agencies, but that they would be given a program that would already be designed. And actually, I've been personally arguing that they have a standardized application in the same way that they had with HUD, though maybe a little simpler, and standardized documents to use so that states don't have to set up their own and design their own programs. We're very, very clear that the problem with the hardest hit funds was that the programs were way too targeted, and it was way too difficult to get people to actually qualify for them. And as I remember in Florida, a 97% rejection rate in one of the hardest hit states in the country. So it's just the money did not get, some states have not actually finished spending that money from 9 and 10 years ago. So there'll be more on that, but we wanted to really get in on this early before the bill has passed, because we need to, because we'd like them to be able to set something up quickly once it's law and in place. And and that's what we mean by how to implement the Homeowner Assistance Fund. Where that is the bill is in the Senate right now. It passed the House. The particular rules it's under are are driven by budgetary rules. It's a reconciliation of the budget, so they have less flexibility about creating and standing up new program, but they can fund new programs, which is kind of how we are able to do what we're doing. There's a lot more in it. You can read about it in the paper. They are really trying to aim for a vote tomorrow. I'm not sure that that's going to happen. There's been a number of delays from people across the aisle from the Democrats. We'll see how quickly that moves. Whatever happens, they are changing the bill, and it'll need to go back to the House for a second vote, and hopefully that all happens. Everything we're hearing is that the housing components that we are most concerned about are non-controversial, and there haven't been any moves that we have seen to change anything. So we're very encouraged about these components. We'll see how they land when we see the final version, but it's encouraging. Their goal is to try to get this passed and signed by the president by the middle of March, because that's when unemployment runs out, and this would provide unemployment along with a $400 bump up on each unemployment check. I'm going to mention one other quick thing, which I have just heard, and would love to know if people have more experience on this. But I received a little bit of information that on unemployment, and this is the critical thing for people to, and this is what's going to get many people through this crisis. it's very good to have the bump up and all that. It was reported on NPR that 70% of the people who are eligible for unemployment are actually not getting it. And the largest reason is that they believe that they are not eligible. And the second one, which is one we did a deep dive on last summer on one of our leaders in housing counseling calls, was that there's lots of barriers about why when people apply, there's a small thing off and you then go into this black hole of in your application, and you have to go through an appeals process, typically in front of a an administrator or administrative judge, and that is a major problem. But they were saying the largest one was that people didn't know. So you are talking to people who are on unemployment for sure, or unemployed, and you should make sure that you tell everybody that that if you can figure out if they're all eligible, they should really try to see if they can access this. It's much better than regular unemployment, a little more flexible, and has more money. So with that quick note, and if somebody knows more about this, we're trying to research this, please let us know. But with that note, let's move over to our student loan experts. Obviously a critical issue for our industry. And we've had student debt crisis on before. They did these wonderful trainings a few years ago that were very helpful. And we have our friends from Savvy, which has the automated program to make it a lot easier for people to figure out which student loan product or solution is the best for them. So with that quick note, I'm going to hand it over to Natalia Abrams, who is with Student Debt Crisis, and please give us the latest.
Thank you so much, Bruce, and we are happy to be back, and congratulations to Latika on her new position. And with that, I think we can get started with the next slide. As Bruce mentioned, I'm Natalia Abrams. I'm the Executive Director at Student Debt Crisis. We are a national nonprofit advocacy group dedicated to fundamentally reforming the way we pay for higher education in America. Today, we are joined by our friends at Savvy. Sounds like they are your good friends too. We're planning to share current COVID-19 updates which for student loan borrowers that we feel is important, when working with your clients. And then at the end, we'll discuss the tools created by Savvy to help your clients enroll in the available federal student loan repayment options. And I believe, as Ellie and Bruce mentioned, there will be time for questions, to answer your questions at the end of this discussion. Moving forward. So I'll let you know a little bit about who we are. Do we also have Lindsay on to just say hello from Savvy?
Hi, yes, Natalia. And Bruce, Ellie, and Latika, thank you so much for having us on today. And it's great to be with everyone. My name is Lindsay Clark. I'm Director of External Affairs at Savvy. Just a quick bit about who we are. We're a social impact tech startup based in Washington, D.C. We were founded by policy experts and advocates who have developed a technology platform to help borrowers better navigate and manage their student loans. Bruce was just talking about the difficulties around some of these federal programs on the housing side that sort of stem from misinformation, miscommunication, and sort of a lack of awareness and education for borrowers. And what our tool attempts to do is to help borrowers sort of understand that process and take advantage of these programs and actually save money and potentially qualify for forgiveness programs if they're eligible. So really excited to be able to sort of walk you through that tool and how you might be able to use it for your communities later on in the presentation. And always honored to be joined by the Student Debt Crisis team here today, because they are the true borrower advocates in this field. So thanks, Natalia.
Thank you, Lindsay. And I completely agree with what you mentioned and what Bruce was saying, that, similar to unemployment programs, with all of these repayment programs, one of the biggest problems is that people don't realize that they can qualify or that it will help them, and they just don't know about them. And so that's why we've turned to NHRC and many groups to let you know for your clients that this is probably something they can take advantage of. And then when you join that knowledge with the use of the Savvy tool, it's just amazing. And that's what we found with our supporters over the past few years, working with Savvy as well. So on to the next slide. So to go over, what's been going on in for student loan borrowers since the COVID pandemic happened, it's important to know that most, and we'll get into this a little bit, most student loan payments, federal student loan payments, or a better way to look at it, all federal direct loans have been suspended, and interest has been waived, or 0% interest for federally held loans until September 30th of this year. So that means that the first payment that anyone with a federal direct loan will pay will be on October 1st, unless we are able to change the policy to be more beneficial for student loan borrowers. This suspension time does count towards public service loan forgiveness and default rehabilitation. It also counts towards months if you are in a income-based or income-driven repayment program. And, I think that's a really important note. Savvy identified that I believe 1/6 of your public service loan credits, your monthly credits, you'll be able to receive essentially for free during this payment pause for federal direct loan borrowers. That's, a huge savings for so many borrowers, and a way to just get a head start on public service loan forgiveness. And if these are new terms for you, we are going to go over them a little bit, and also happy to answer your questions at the end of the workshop. In addition, borrowers do not have to currently recertify for their income-driven repayment plans. These are plans that you need to recertify each and every year for upwards of 20 to 25 years, and borrowers currently will not have to recertify. They'll be able to remain on that program. Moving forward. So what is public service loan forgiveness? This is a program that began on October 1st in 2007, and that's important because even if you have a client that worked in a public service job, the time only starts counting in 2007. On top of that, borrowers need to make 10 years of monthly payments, or specifically 120 monthly payments. They cannot make double payments in a month. It needs to be per month. And all of these payments must be made under the borrower having a federal direct loan. Direct loans have been around for a while, but in 2010, after establishing the Affordable Care Act, all loans became direct loans. I mentioned that just if you're working with clients that have their loans post 2010, you don't have to worry about this direct loan, not direct loan issue. That date makes it easier when we're dealing with our borrowers as well. For borrowers that are in the Public Service Loan Forgiveness Program, payments, must be made within a qualifying repayment program, which is why we always talk about the income-driven repayment programs when talking about public service loan forgiveness. And this is probably the best part. After you make your 120 payments, then all of the debt is forgiven completely tax-free. Moving forward. So similar for the COVID-19 relief, the pause on payments and interest started on March 13th, but in March of 2020. And so we're almost a year in now, and will extend to September 30th, 2021. So 19 months, we see right here, it jumped a little ahead, that this is 1/6 of the required payments for free for borrowers that are on track. And we highly suggest, and frankly, the only company that we work with in this space at Student Debt Crisis is providing the Savvy tool to our borrowers, so they can make sure that they're taking advantage of all of their public service loan forgiveness credits, not just during this COVID period, but throughout the whole span of that 10-year process. Moving forward. So some other COVID relief to keep in mind: tax and Social Security withholdings for federally held student loans that are in default have been suspended. So right now, borrowers that are in default, that means failure to pay for about 9 months, you get put into default, which is kind of a fate worse than bankruptcy for borrowers, and I'm sure you've had to deal with that. But right now they are receiving their tax returns or their Social Security checks. So that's a very good thing. Then on top of that, also, employers have been instructed to halt all wage garnishments for federally held student loans. And borrowers who have had wage garnished after March of 2020 can receive refunds. So that's an important thing to note as well. If they have been having, any withholdings or having garnishments, there is a potential for your client to receive a refund. But lastly, collection activities and calls. We hear from our borrowers all the time that they are harassed by multiple phone calls or daily phone calls from student loan servicers. That has been paused along with mailings to borrowers as well. So, these are decent, provisions that are going on right now for student loan borrowers under the CARES Act and the administrative extensions. But we just, at Student Debt Crisis, we want to make sure that borrowers are aware of all their options, and then who benefits from this and who doesn't. The last thing I'll mention before passing on to Cody is the other good part about the way this has been enacted versus what we were talking about with repayment programs or unemployment is this was automatic. Nobody had to apply for anything or receive confirmation or show up before a judge. This was an automatic, action that was taken, and borrowers just stopped paying or didn't have to make payments and automatically received the 0% interest. And with that, I'll pass it off to my colleague, Cody Hunanian. Cody?
Thank you very much, Natalia. So I hope to clarify some of the nuances and developments, because I know when we talk to borrowers, which is, every single day, there is quite a lot of confusion. And I don't have to tell the folks on today's call that are very familiar that unfortunately many of these federal programs are developed as a layer cake. They can be confusing. So let's first start off with the timeline of how COVID-19 relief was developed, because this is something that has created a lot of confusion for the borrowers that we speak to. So, first and foremost, in March of 2020, Congress passed the CARES Act. And the CARES Act was the first response to the COVID-19 pandemic that provided student loan relief. And the CARES Act paused payments and interest, and also included the benefits, the suspension of debt collection activities, and the like. The problem was the CARES Act was very short term. So in 2020, former President Donald Trump extended relief until January 1st of 2021. Now, obviously, the pandemic was still in full swing, and in many areas worse than ever at the end of 2020. So it became apparent that this relief needed to be extended immediately. So President Biden, one of his first actions was an executive action to extend the pause on student loan payments, the waiver of interest, and the pause on debt collection activities until September 2021. That is where we stand now. The president has signaled that there is a willingness to extend the deadline again if needed. That is something that is not being discussed currently. So as we speak with you all today, we're looking at October 1st as the new, what we call the repayment cliff. That is when millions of student loan borrowers are going to be put back into repayment. It's an important date because we expect there to be procedural and administrative issues with bringing millions of people back online at that time. So let's go to the next slide here. Who receives COVID relief? That is another issue that has created a great deal of confusion for borrowers and advocates and counselors as well. So Natalia mentioned student loans that are federally held by the Department of Education are automatically eligible. Now, I got to really focus in on that term, federally held. So a federally held student loan is different than just the term federal student loan. Federally held means it's a student loan that the debt is owed directly to the Department of Education. Now, the current relief excludes over 9 million other federal student loans that we call, quote, commercially held. Now, these are federal student loans, typically from older programs that are not used currently. They're federal loans, but the debt is owed directly to a private bank. So in reality, the federal government acts as a guarantor for these loans. So if you're working with a client that has an older federal family education loan, what we call an FFEL loan, or a Perkins loan, this is a type of federal loan that comes directly from a university, they may or may not qualify for COVID-19 relief. And that's where the confusion comes in. So we cannot look at a FFEL loan and say definitively that loan doesn't qualify. What we need to know is who owns this debt. Is this an FFEL loan currently held by the Department of Education or a private bank? In all reality, as Natalia mentioned, if your loan qualified, you almost certainly have automatically started to receive COVID-19 relief. So that is not an issue that we hear of too often, but we do hear from many borrowers that reach out to their loan servicer and are written off because of the type of loan they have and cannot get accurate information related to who qualifies and who doesn't. And lastly here, something that's constantly a frustration for advocates is that federal relief doesn't even touch the private student loan market. You know, these are private loans are the types of loans that you walk into a bank, a Wells Fargo, or you go to that you access through a company like SoFi and things like that. Those are not covered by COVID relief. So just a quick visual, because there's a lot of verbiage being thrown around here. These are the types of federal student loans. On the left here, we've got direct loans. Those all direct loans are held by the Department of Education, so those automatically qualify. It's the Perkins loans and the federal family education loans that may or may not qualify depending on who holds the debt. And next slide, please. So for those borrowers that are excluded from relief, that doesn't mean that there's no options available to them. There are programs that existed prior to the pandemic. We've talked about them here on NHRC calls in the past that can help make a borrower's payments more affordable. For example, the most powerful tool is what we call an income-driven repayment plan. And I'm sure Lindsay at Savvy will talk about this later. Their tool enrolls folks in these programs. But just as a quick reminder, there are these income-driven repayment plans that your client can enroll in if they aren't currently receiving relief. Now, what an income-driven repayment plan does is it bases your monthly payment as a percentage of your income and family size. So instead of your monthly payments being pegged based on the total amount you owe, it's supposed to be a more reasonable and affordable rate based on your income. So for a borrower that makes very little income, their monthly payment could be as little as $0 per month. As another reminder too, there is a forgiveness mechanism at the end of income-driven repayment plans. So a borrower can recertify their income and stay in these programs for up to 20 or 25 years, depending on the plan. That type of forgiveness possibly comes with a tax burden. So that's another detail that's very important here. But these are the basics. These are the options that are available to people that are currently not receiving relief. And frankly, these are also programs that are available to borrowers who are receiving relief now, but are looking at that October 1st deadline or this October 1st cliff as a huge burden and want to enroll in an affordable repayment after relief ends. So we want to make sure that you all are aware of this choice. Next slide. So just as a quick example of the power of these programs, here's someone who's single, has one child, and has $37,000 in student loan debt. Under the 10-year standard plan, that's just the normal terms of a federal student loan, they would pay $364 per month. Under an income-driven repayment plan, their monthly payment can be as little as $0 per month. And you can see as we work our way up, there's still significant savings, even for a borrower who earns $50,000 per year. We don't get into it today, but we've talked about it on other NHRC discussions, but the income-driven repayment plans have been viewed for mortgage purposes much more favorably over the years as well. Policy changes that we have worked with the NHRC have helped change the way that particularly like Fannie Mae looks at these monthly payment obligations. So one other thing that's quite confusing for borrowers is the fact that there's current COVID relief, but there's also currently a very robust discussion and debate about the future student loan policy and solutions that are on the table. So you may actually have clients reach out to you. They may come to you and say, I heard this is happening, or I heard, senators talking about this solution. Most of these are still in debate, but we want you all to be aware of where these policy discussions stand so you can understand what the lay of the land looks like. So, probably the most visible of the discussions is the call for student debt cancellation. Currently, the Senate and the House have called on the president to cancel $50,000 in student loan debt through a bicameral resolution. That has received an incredible response from our supporters and advocates. We currently work with a coalition of over 300 organizations that support this plan. So it's very visible right now. On the other hand, the president wants $10,000 in student debt relief, and he'd like to see this type of relief passed through Congress. This is still a discussion that's being had, and we are, deeply engaged in this debate and favorable for the most amount of relief for the most amount of borrowers. There are other solutions, though, that are still on the table, and we need to think about how to help borrowers who are struggling today. One of those is what we call the Parity Solution. This plan would extend the COVID-19 relief to all federal student loan borrowers. So when I talked about the 9 million loans that were excluded from COVID relief, just because of the type of federal student loan they have, it's inherently unfair, and frankly, it's left millions of people without any relief at all for over a year now, as we've been, reaching a year now as we've dealt with this pandemic. So that is another solution that we are working on. We would like to see all of the COVID relief extended for everyone that has a federal student loan. And lastly, there are many other fixes to current repayment programs, including ways to make public service loan forgiveness actually work, making the income-driven repayment plans more affordable and more generous for borrowers. These are all fixes that I think the president, as well as many lawmakers, support, and they still remain on the table for future discussion. And lastly, I just want to share what we feel is a really important report from the National Association of Realtors. Throughout this last year, every issue has been connected to the intersectionality of racial inequity. And that includes student loan debt, and that obviously includes homeownership as well. And so the National Association of Realtors just released a report that connected the issues of student loan debt inequities with Black borrowers and obstacles to home ownership. And I think it's really important to understand how all of these components are working together. So there is, according to the report, a homeownership gap of 30% between Black and white home purchasers or potential homeowners. So that is a huge disparity that prevents Black families from owning homes, but also creates a whole domino effect when it comes to building family and generational wealth. They looked even more closely into why this is happening, and one of the issues that came up was the fact that Black households were twice as likely than white households to have student loan debt. In fact, the median debt for a Black household was $40,000. That's almost 30% higher than their white peers. So, the National Association of Realtors felt that a greater likelihood of having student loan debt combined with lower household incomes and wealth created a huge obstacle to homeownership for Black borrowers. As Bruce mentioned, it sounds like the Black homeownership issue will be a priority in the months and years to come. That is also a huge issue for us at Student Debt Crisis, and there's obviously a lot of intersectionality here that's really important. So with that, let's go to the next slide. I want to pass it to Lindsay at Savvy, who is a great partner of ours and a great partner of NHRC. Lindsay, if you're on the line, take it from here.
Yes, I'm here. Thank you so much, Cody. So just to touch briefly again on sort of who we are at Savvy, I think it's so important and can't sort of emphasize it enough. Our mission as a company, as a public benefit corporation, to serve that public good, working with organizations like NHRC and Student Debt Crisis so closely in ultimately trying to solve the student debt crisis, but really putting the borrower first and helping them achieve some type of relief and ultimately freedom from their student debt. Oftentimes, the borrowers that are able to utilize our services and technology, see on average about $156 in reduced monthly payments. Lifetime average savings around $28,000. And so far with our tool, we found over $200 million in forgiveness for borrowers. So as I said, we come from a policy and advocacy background. So the work that NHRC does on a day-to-day basis is so important to our DNA as well. And looking forward to being able to tell you more about the tool. The next slide. Great. So essentially, Savvy is a web platform where borrowers can go and you can take your borrowers that you might be working with or members of your community to be able to essentially almost like a TurboTax for your student loans. You can kind of think of it that way, but to be able to really better understand and manage that student debt. So some of the features that are included are the ability to check your eligibility and qualifications for programs like Public Service Loan Forgiveness, the big forgiveness program, if they are eligible. Borrowers are also able to see a personalized repayment and forgiveness plan. This is based on the information that they enter into the tool. It is all customized and personalized to them, not national averages. It is specific to that borrower. And then if they decide to enlist our help with sort of our premium level of services, we actually take on all of the heavy lifting around the applications, the forms, and all of that's required to actually get enrolled and stay enrolled in these programs on a yearly basis. We do that for them and on their behalf. With our digital integration, they're able to easily e-sign from their phone. It comes back to us. We review that document. It reduces human error and submits it on their behalf to their servicer within minutes. And these are programs that, again, borrowers have not really been able to access, have either been denied for clerical or administrative errors one way or another, or are really not able to optimize because of their lack of understanding. And so this is where we come in. And again, we help with all of that yearly recertification around those repayment and, if eligible, forgiveness plans. And I think one of the most important aspects is not only just the application submission and that being all digital, especially given today's circumstances, but the fact that once we submit that application, we then monitor that application to ensure that it achieves the desired outcome. And I feel, I'm sure many of you might be able to relate as borrowers yourselves or working with borrowers, that's really that sort of end of the marathon where many borrowers will end up falling short of reaching that finish line for one reason or another, whether they get rejected, don't hear back from their servicer, are waiting, weeks, months, sometimes years. This is really where borrowers are being sort of at a disservice, and the crisis student debt crisis is highlighted for us. So by monitoring all of this process for the borrower, if applications are taking longer than they should for the service order process, we're able to work with that borrower one-on-one to follow up with the servicer and push that forward, including escalate their applications through the ombudsman or CFPB if necessary. And last but not least, it goes sort of hand in hand in what I was just talking about. They're able to receive one-on-one support from student loan experts. This is our internal support team that is able to talk to them over the phone or via email at any point in time. So that being said, to get started with the Savvy tool, you can go to nhrc.buysavvy.com, and we can maybe put that link in the chat so it's easily accessible. And this is where you or members of your community can access the NHRC Savvy microsite. This is a specific and designated site for the NHRC realm, you should say, or community of sort of associated partners. And we start out by asking borrowers two pretty basic questions, and that is their expected income for the current year and their current federal student loan payment. And so just using those two numbers alone, if we go on to the next screen, great. We're able to run a quick estimate and determine initially what that savings could look like on an income-driven repayment plan. So if you see that number in the top left-hand corner of that screen, that $121 a month, that's going to update in real time based on the information that the borrower is entering into the tool. So as I said before, you can kind of think of it almost like a TurboTax for your student loans. We're going to be asking the borrower very basic, simple questions around their taxes, their income, their employment. All of these are to help us identify the optimal repayment and, if eligible, forgiveness program for that specific borrower. So all of this, again, when they enter that information in, that number is going to update and show them what potential savings they could be eligible for. Specifically, if you have a dependent that is a child, that's going to lower that monthly payment by about $50. So again, all of that will be reflected in that estimated payment. On the next screen, is the income section. And so this is where we'll need to verify their adjusted gross income, or AGI. Now, if many borrowers might not know what that is or where to find that, so on the right-hand side of every question in the tool is that little question mark with a circle. That's what we call a tooltip. If a borrower were to click on that, and if we go to the next screen, it will expand to provide more information and context about the question being asked. So in this case, it's going to tell the borrower where they can find that AGI, what line on their tax form. We even provide a link to the IRS website where they could download their tax transcript. So we try to make this whole process as user-friendly and easy on the borrower as possible. Actually, about 50% of all of our users access Savvy through their mobile phone. And while we don't have a mobile app, we're 100% mobile friendly, so you can use the Savvy platform on any internet browser on your mobile device and make it through just as fine, if not faster, in about 10 minutes or less. Moving on to the next screen is the employment section. So we have a database of all of the Pslf and TLF, teacher loan forgiveness, eligible employers in the country. And so when a borrower is going through and enters in their employer, if it is an eligible employer, it will identify in a drop-down menu, which they'll be able to select, and then our tool will be able to sort of acknowledge for them that they could potentially be eligible for either one of those forgiveness programs based on that employer. So this section is sort of critical to being able to help identify any borrowers who might be able to take advantage of those programs. Going on to the next screen, we not only help them to certify current employment, but any previous employment as well. And for those who are, really familiar with these forgiveness programs, employment is really the name of the game as far as your eligibility goes. So these programs, specifically public service loan forgiveness, is retroactive. And so this is really where most of the work comes in for borrowers in having to go back in time to their previous employers and trying to certify those credits on their own. We take care of all of that for the borrower. We set up all of those forms digitally for them. we actually send them to their previous HRs on their behalf, make sure to get those signatures correctly and that information, review and then submit to their servicer on their behalf. So all of that legwork we take care of for the borrower. Again, reducing that human error is a huge part of this process, a huge pain point for so many borrowers, and they never really make it past it. So we're determined to reduce that barrier to entry as much as possible. On to the next screen. Perfect. So at this point, the borrower would be prompted to create their free Savvy account. And this is just their first, last name, email, and password. This is because we're about to enter into the loan sync portion of the tool, where borrowers are going to be syncing their student loan data. So we obviously want that to be, stored securely and for them to be able to access that securely in the future. So again, this is completely free at this point in time. On to the next screen is the student loan sync. And this is actually one of the neatest aspects about the technology itself. So, borrowers on average tend to have anywhere between 5 to 6 different federal student loans. The loans aren't dispersed in one huge lump sum, but, throughout their years of study. And so what makes it really easy for borrowers to sort of be able to, or I should say for us to be able to gain insight into the borrower's loan situation is through this loan sync. So a borrower can identify their federal servicer, whether that be Navient, Nelnet, FedLoan, whatever, enter in that username and password credential, and it's going to sync over that data in real time and read only. So it's not giving us access to the account, it's just giving us a snapshot. We use Plaid, which is a best-in-class technology syncing platform. If you have a Venmo account, you've used Plaid to sync your banking accounts. And they work with pretty much most of the big financial apps out there today. So it's sort of the highest level, best-in-class security and technology as far as syncing goes. And this allows us to be able to get a glimpse into exactly what's going on with that borrower's student loans, specifically the type of student loans they have. This is where we'll be able to identify if they have one of those older FEL loans that Natalia and Cody were talking about, that they potentially would need to take corrective action in order to make eligible for some of these programs. So it's a really important step because so many borrowers are often unaware of their loan type or how important that loan type is going to be in determining their eligibility. And this is where we can help them to do that. Flag if there are any issues that we see, and then again help them to take that corrective action. And I will say, while 90% of the student debt out there is federal, 10% is private student loan debt. And most borrowers that we see who have private loans also have federal loans, because usually you pursue your private loans after exhausting your federal options. So we tend to see borrowers with both. And for borrowers with private loans as well, they are able to sync those loans to the system just the same. So they could identify that third party or commercial servicer, whether that be Wells Fargo, Discover, Chase, enter in those username and password credentials, and it's going to sync over those private loans. And what it will do is it'll flag for our team that they are private loans, and we'll be able to reach out separately to that borrower and talk through what options might be best, given the fact that with private loans, they are far more limited in what they're going to be able to pursue. And then once they've synced those loans, perfect, they reach the plan results page. And this is where we will identify the optimal repayment and potentially forgiveness plan for that borrower. So they're going to see what they could lower that monthly payment down to, what that monthly savings looks like, and potentially how many years until they are done in repayment or potentially eligible for forgiveness. They can expand for more details below. That'll provide them with sort of an overview on the specific programs, what an income-driven repayment plan is, what the pay plan is, if they're eligible for a forgiveness program, what specific program and what's entailed. So sort of a real in-depth look at exactly what we're showing them. And that at that point, if they say, this sounds great, I want to proceed, on the next screen, they will be prompted to do one of two things. They can either continue completely for free under our DIY plan, and I'm going to talk about that in a second, or they can choose to have us do all of the heavy lifting around their application, the monitoring, and engage our sort of premium level of one-on-one support for $60 a year. And that's a reduced price thanks to the National Housing Center. And I'm going to talk a second about sort of the differences between that DIY and free plan, DIY and premium plan, I should say. But I just want to make note, we are very transparent about the fact that these are free federal programs that borrowers can enroll in through the Department of Education and their servicer. And that being said, that's why we offer a DIY completely free version, because we think that that's so important. And so for borrowers who want to pursue those options on their own and take care of the paperwork and do all of that, they can do so. And we actually, on this next slide, provide them with links to the applications and instructions. So we try to sort of get them as far of the way there as possible at absolutely no cost to that borrower. And they're always able to send us any questions that they might have over email, engage in our help center, and our support team is there to support them through that process. So that is the DIY plan that they're able to get for free. As far as the premium essential plan goes on this next slide, so I had started going into some of these features before, but again, this is going to take care of all of the heavy lifting around any repayment and or forgiveness applications, digitally pre-filled for that borrower, making it very, very easy. And really, they don't have to do anything at all except e-sign the application. We review it manually and then submit it to their servicer on their behalf. We then monitor that application to ensure it not only is processed in sort of the appropriate amount of time, but that borrower is getting the actual payment amount that they should be. Oftentimes, we've seen servicers come back and incorrectly calculate these income-driven repayment plans. So, many people think that the servicers are, the end-all, be-all, and are oftentimes unaware that they make mistakes all the time. And so, really that's just hurting the borrower. And that's where we come in, because we're sort of that double check on everything. Again, monitoring that, and then providing one-on-one premium support at the convenience of the borrower. Whenever they want to schedule or pre-schedule those calls, they can do so, whatever sort of form of communication works best. And that $60 a year is 100% money back guarantee. And by that being said, no questions asked. We could submit applications for a borrower. They could have paid the $60 and then they could say, you know what, I got on the plan, I don't see any value anymore, and we would give you your money back. And we find that borrowers who tend to use our premium services, it's not a difficult one to convince them based on their student loan experience and how difficult it's been thus far. I will note that $60 price is for non-NHRC members. Those who are members of NHRC actually receive a 50% additional discount on that essential price. So that's $35 a year for any NHRC members. And I know Ellie and Bruce, you can follow up with them directly if you are a member and curious to access that link in order to take advantage of that discount. And for those who aren't members, I'd be sure to follow up to see how you might be able to become a member, I'd say, to be able to take advantage of that for your communities. On to the next slide. This is the Savvy dashboard. And this dashboard is essentially home base for everything the borrower will be doing with Savvy. This is where we have a full sort of visibility and transparency between us and the borrower as to where they are in the process, what's been submitted on their behalf, what might be needed from them, and what we're waiting for on the servicer. So there is, especially because there's so much misinformation, miscommunication, nefarious actors in the student loan world, it's really important for us to make sure that borrowers feel secure, understand, have the right expectations, and full visibility into the entire process of working with us. It's also where they can see announcements about things like upcoming webinars that they might be able to join. We provide our users with monthly all user webinars, including policy updates and things like that. It's also where they can access our support team and upgrade or downgrade from a plan at any time. On the next slide, I wanted to just point out a really great feature here. So on that dashboard, you will note there is an invite family and friends. And this is where borrowers can invite 3 family or friends, doesn't matter who, and actually receive a 50% discount off that essential price. So that would lower that down to $30 from that $60 for anyone who invited 3 friends or family. And for any NHRC members, that's going to cut that down to $15. So, hopefully that is a helpful way, but I just wanted to point that out to anyone who might be interested. And really the whole intention of that is to sort of pay it forward as a borrower to other borrowers in need, right? If you know someone with student debt, oftentimes student debt can run in families. I have student debt. My dad and brother both have student debt. And so it's a way for, a borrower to be able to help and engage other members of their family and community around the student loan relief. And on the last slide, or next slide, I should say. Perfect. So I just wanted to point out our Savvy support team and how borrowers can access them. So on the bottom right-hand corner of every slide of the tool, or page of the tool, I should say, is a chat or support button that they can click and either chat live in real time if during our business hours, or send a message easily to our support team that responds within 24 to 48 hours. And again, they can access our help center as well that has really great content and FAQs that any borrower would find helpful. So lots of ways to be able to contact our support. And again, through that premium level, they're able to set up one-on-one conversations for a half hour, all times of the day at the borrower's convenience. So with that being said, that is, I believe, the end of the Savvy part of the presentation. And I believe it's great question time. So happy to answer any about Savvy specifically, and thank you so much for giving me the time to talk to you today.
Thank you so much, Lindsay and Natalia and Cody. Very helpful. So obviously we're going to go over the hour. We're already past that a little bit, but we're going to take at least half an hour for questions. I'm sure there's a bunch in the box. I'm going to ask a couple just to get us rolling. One is, so I'd love to get an update on how the Public Service Forgiveness Program is actually working. There was this whole thing about people who had reached their 10-year period of time and were not able to qualify. Has that been improved, and what are the pain points there? Because it's an important issue for all of us.
Yeah, absolutely. And Lindsay, definitely feel free to jump in on this. But, the biggest issue we saw with public service loan forgiveness is what Cody and I were talking about with the direct loans versus the FFEL loans. So many borrowers didn't qualify just because simply they were in the wrong federal loan. So they thought they had a federal loan, they worked at a public service job, they may have even been in the right repayment program, but it was the loan type of those loans that were offered before 2010, which were like the first 3 years of the program. And if you didn't consolidate, that was the problem. The other problem that we saw were borrowers that did have direct loans, but they were in some older, not as generous repayment programs, such as extended or graduate repayment. And that's where I'll pass to Lindsay to talk a little bit about TEPSLF.
Yeah, thanks, Natalia. So for these borrowers who, ticked the right box as far as their loan type and ticked the right box as far as their employer, when it came down to the repayment plan, this is where things started to get a little tricky. So a couple of years ago, actually, Congress appropriated a large fund of money to essentially help borrowers who, for lack of a better term here, had been screwed over by the PSLF process and program. And this is called TEPSLF, or Temporary Extended Public Service Loan Forgiveness. And TEPSLF is designed for borrowers like I just described, those who had the right loan type, worked for a qualifying employer, have made 120 payments, but were just not on the right type of repayment plan. They were on a standard repayment plan. And so for borrowers who meet that eligibility, they are actually able to apply and receive essentially the same as public service loan forgiveness, full forgiveness on the remainder of their student loan balance. And so initially the rollout of TEPSLF was very rough. And by that I mean the requirement to apply for TEPSLF involved first having to apply for PSLF and getting rejected. And so to get rejected from PSLF could take upwards of months to a year or more, we've seen, just to get that official rejection, at which point then they would transfer you over to the TE-PSLF side to see if you could be eligible for that. So it was a whole sort of convoluted mess. And more recently, I would say within the past year or so, they've been able to streamline that to the point where now the sort of application for public service loan forgiveness, the employment certification form for public service loan forgiveness, and the application for TE-PSLF, temporary extended public service loan forgiveness, are all one application. So it's one document borrowers are able to submit and basically achieve any one of those three options through that form. And so this is, I think, going to really help as far as just making things simpler on the borrower's end. You know, I'm sort of hopeful about you know, how that will play out, and we're definitely thankful as far as you know, managing and tracking all of that documentation. But as Natalia mentioned, you know, really seeing so many borrowers get denied and rejected early on in that program, and having to sort of start over, you know, start from zero basically and build their credits upwards. You know, I think that's what we're going to see. Sort of, it'll be a slow increase, you know, over the next couple of years in acceptance, and then really start to surge because many more people who, you know, were eligible or who, you know, had to sort of restart or get, you know, weren't able to take advantage of all their years of service are then going to, and at least by now, hopefully understand what's involved in this process, get on the right track, and start to take advantage of those programs. And I would say, despite COVID right now, the fact that there is a payment pause means servicers aren't really doing much, right? They're not having to process payments like they normally do. And so we've actually found that the application process for PSLF and specifically teacher loan forgiveness has sped up, you know, tenfold. And so that's great news for borrowers. And so we're excited and sort of hoping to take advantage of that for anyone eligible, to make sure that they get that paperwork in and are able to have it processed quickly right now.
So one of the quick thing I'll mention is that FHA, Cody mentioned that the way that Fannie and Freddie had valued the repayment plans rather than taking the actual payment, they were doing a percentage. FHA continues to do that and does 1%. And we have raised that with the Biden-Harris transition team, and we've we have a variety of things we want to do with FHA, and that's on the list. And when the new secretary is in place, which we hope will be soon, that will absolutely be on the list of issues that we elevate with her. So let me turn this over to Ellie, and who's the master of all our questions. And Ellie.
Thanks, Bruce. So there are a couple of questions around this one topic that I think to some level you've answered, but I'll put a finer point on it. And basically, people are wondering if folks who haven't already applied for PSLF but have been working for a nonprofit can backdate some of their eligibility and get credit.
Yes, you know, that's the great thing. If you are in the correct loan and in the correct repayment program, and you've just found out about public service loan forgiveness, you can backdate all the way to 2007, or when your client entered into a direct federal student loan. Because many folks consolidated from the FFEL loans they would have had to consolidate from an FFEL loan to a direct loan before 2010.
And just to add on there too, and this is really where I think a major pain point has come in for so many borrowers, because the process of retroactively getting those certifications can almost feel like a full-time job at some points, because it's going to require going back to however many previous employers you might have had along that way, and getting sign off from that HR for that period of employment. And especially sort of the challenges that COVID has brought into the mix here as far as, everyone, not everyone, I should say, large majority of workforce being remote, and things having to be done potentially digitally. And so, or even maybe your HR department is entirely different than it was when you worked there 5 years ago, and, you can't get, the right contact, and they won't sign, et cetera. All of those sort of like, process-oriented delays that many borrowers face, and then end up just sort of giving up on it, to be honest. This is where sort of Savvy is your full-time concierge. So it's our job, it's our full-time job to make sure and follow up with that previous employer's HR to find the right contact. We pre-fill the whole entire form for them, make it as easy as possible, and collect that signature. And we monitor that for the borrower. So they literally just tell us what those previous employers were, and we do the rest of the work. So for anyone who's ever had to fill out those forms before, can appreciate probably how much of a value that is.
Great. So does a $0 IBR count as a payment plan to qualify for the PSLF?
Yes, it absolutely does.
Okay, well, that's a simple answer.
Yeah, exactly. Yeah, I would just say to that, IBR, income-based repayment, is a type of income-driven repayment plan, and any of those income-driven repayment plans, Repay, Pay, IBR, ICR, all of those sort of fall under the umbrella of income-driven IDR. They are all eligible for PSLF, and yes, a $0 monthly payment, if you are eligible for that, is going to count as a credit towards PSLF, so long as you have a direct loan and you are working full-time for an eligible employer, just to clarify.
Okay. All right, so someone is enrolled in the PSLF program and is still making the monthly IBR payments, but when they got the recertification for last year, the payments that had been made during COVID-19 were not counted as payments eligible under the PSLF. Can you advise what to do in this situation?
So I have a feeling, it sounds like this borrower might have been continuing to make payments during the payment suspension.
Yes.
Okay.
Yes.
So even though they were eligible for the suspension, so I'm not sure if they were doing that intentionally, thinking that they needed to in order to get the credit, or if they were, for another reason. But this, as Natalia had mentioned, during this payment suspension, those months count as PSLF credits without having to make a payment. So what I suspect, if you were making additional payments on that student loan during that time, it's not going to count as additional credits, if that was the intention. You will still basically be able to from March of 2020 through the end of September 30th of this year, so about 19 months worth of credits that you could be eligible to recoup, so long as you had the qualifications of loan type, repayment plan, and employer. I hope that may provide some clarity. Cody and Natalia, I'm not sure if you have any ideas here.
Well, I think that's entirely accurate for this circumstance. What I wanted to flag, because I think it is somewhat related, is another pain point that's happened for borrowers before the pandemic began and before payments were paused. So many borrowers we speak to, and most borrowers in general, even if they're interested in loan forgiveness, have a deep desire to pay back their debts. And so we talk to many borrowers who are on track for public service loan forgiveness, but they've decided to pay a little bit extra here and there on their monthly payments to get ahead. And they think they're doing the right thing, which in any other circumstance they are. But what has been a problematic detail related to PSLF is that you need to make the exact payment that is asked of you under whatever repayment plan you're in, or it can have a domino effect. And so some borrowers have paid more on their monthly payment than was asked of them. And what it's done is it's made a domino effect where payments after that did not count towards PSLF. This is an administrative issue that, frankly just doesn't make any sense. But it is something that is a problem. So, this is where attention to detail and making sure that you are just making the payment asked of you will ultimately benefit you in the long run because it'll make sure that every payment after that is counted towards your 120 monthly payments. And Lindsay, I don't know if you've heard of folks having this issue, but with payments being on pause, I imagine there's some people who will still be making manual payments to get ahead of their loans. And I don't know, I haven't heard of someone having that domino effect happen during the pause for COVID relief, but that is an issue that existed prior to the pandemic relief starting.
Yeah, Cody, we have absolutely seen that with many borrowers across the board before the COVID relief. And, it's one of those things also where, from servicer to servicer, we've also seen variation here. They're all sort of supposed to be monitored and managed through the same Department of Education, but we've seen different outcomes from different servicers. And I sort of emphasize a point here again of, the role that servicers play in the outcomes for borrowers. And how that can oftentimes lead in disaster, misery, or sometimes, success. We've seen a servicer who approved a teacher loan forgiveness application for a borrower on $25,000 of their loans. If anyone's familiar with the program, that forgiveness program caps at $17,500, but somehow they did that, right? So anyway, that's rare that it works out in a borrower's favor. But I would say, yes, that's something to definitely be wary of. I would say for anyone who has been making payments during this suspension, thinking that they needed to in order to receive credits for PSLF, you actually can receive a refund for those payments from your servicer. I actually was working with a borrower yesterday who was able to receive that very easily from FedLoan because of those payments that had been made. So, just to note that, but Cody is absolutely right. Sort of the timing of your payments is very important, and for what amount. And I would say one of the ways to avoid any issues there really is to make sure that you are certifying on a yearly basis. That employment certification form every 12 months. That way your credits are staying up to date. So if you submitted that and they only gave you 8 credits, right, you would be able to know right away and either follow up and obviously the resources at Student Debt Crisis and Savvy could help, but you would be able to address that then and there rather than finding out 4, 5, 6 years too late into the process and then sort of facing a mountain as far as actually getting to the finish line.
So, and just as a reminder, I remember on the first round of all this, when we're talking about public service loan forgiveness. So if you just sign up for it now and you've been working for 4 years with a nonprofit, you can take credit for those years that you've already done, and I guess you certify them as well. Is that right?
Yeah, so you could gain credit for those years so long as you fulfill the other 2 requirements, which are around your loan type and your repayment plan. So I can't emphasize enough how important those 2 are, because what many people just assume is they work for a qualifying employer and therefore they're eligible, but really the other 2 are where many people are actually denied from the program. So, but yes, if you are fulfill all 3 of those requirements, then the employment certification form, if you worked for a different employer, would just get filled out by them, signed off and submitted to your servicer, and your servicer would then go back to verify your payment record during that time and matching up with your employment, and then you'd be able to recoup those credits. I would say, however, the longer a servicer has to go back in time, specifically if you currently, or if FedLoan is not your servicer, so let's say you have Navient and you're just finding out about this, your loans will eventually get transferred to FedLoan. FedLoan is the only servicer that manages the public service loan forgiveness process or program, okay? And so for borrowers who don't have FedLoan, they have another servicer. When you submit that employment certification form for the first time, your loans will, and you get sort of approved to sort of track towards public service loan forgiveness, your loans will transfer over to FedLoan. So nothing will change about them, but you'll now just log into FedLoan and do everything the same through FedLoan. But to my point earlier, the longer back in time that FedLoan has to go to sort of verify those credits and that payment and employment, the longer it is going to take for them to do that, and the increased chance of error that they will not calculate credits directly, or that you will run into issues with those calculations. We've seen upwards of a year to 2 years of borrowers struggling with Fed loan to go back, through a 10-year period, and coming back with half the amount of credits that a borrower thought that they were eligible for. One last thing, sorry, Bruce, I would mention there is, once your loans transfer to Fed loan, your previous account no longer exists. And so I would recommend for all borrowers to make sure that they have a downloaded copy of their payment history with their current servicer. That way, if they do run into any issues and there are any questions about their payment history with the servicer, that they have a record of that on their end, because it will no longer exist on their own end after their loans get transferred to Fed loan. And like I said, I can't, relying on the servicers to sort of do these things accurately is not ideal. You want to they can't be given the benefit of the doubt, to be honest.
Okay, quick question. Are NELNet loans covered?
It depends on what type of NELNet loan. So, and by covered, I'm not sure if borrower means covered by the CARES Act relief or covered by PSLF. But the loan, regardless of your federal servicer, really what matters is that you have a direct loan. And so it should say the word direct, or DL, which stands for direct loan. And that would indicate that it is eligible for PSLF. As far as eligibility for the CARES Act suspension and payment suspension and interest waiver, really the easiest way you could tell is payments were automatically suspended. So if your account shows a $0 payment and 0% interest, that means your loan type was eligible. If it doesn't, okay, if you're still having to make a payment, then that either means you had an older type of loan, a FFEL loan, that was not eligible under the CARES Act, or perhaps it could be a private loan. These federal servicers also sometimes service private loans. I have both federal and private loans with Navient, and private loans were also not included in the CARES Act. So hopefully that provides some more clarity there.
Yep. Okay. So regarding FFEL loans, since you did mention that, is there a way to tell who holds it?
I would probably say, oh, go ahead, Cody, you go.
Oh, Lindsay, I have not, in my experience, been able to quickly and easily gauge who owns federal family education loans. My experience has been that borrowers should reach out to their servicer and hopefully can access accurate information about their loan. But if you have other insights, I'm happy to hear that.
Yeah, I was going to say, sort of one of the truest sources here is your NSLDS file, which can be downloaded from the studentaid.gov website. You can log in using your FSA username and ID, which oftentimes this might have been the one you created back in college to take out the loans in the first place. So many people often have to, reset their account. But that's sort of the federal government's record of your loans. It will just show federal loans, but you can download that report and it will show you, it should show you the owner and guarantor of the loan.
Yeah, Lindsay, I think that's great advice. I think one of the issues that we face often is the policy, the rules created by Congress, the Department of Education. They use these terms like direct loan, commercially held, federally held. But when a borrower gets their statement from their loan servicer, it's often communicated in a way that looks very different, right? And so Lindsay's spot on. Going to the Department of Education's database to try to find information directly from the source can be helpful, because it's not necessarily the case that a borrower opens up their statement and it says you have a direct loan that's commercially held by this company. It can be, somewhat interpreted in, bank statement speak that makes it very hard for borrowers to really understand what they're looking at when they open up their monthly payments.
Yeah, absolutely. It's I had both direct loans and I had FFEL loans. One that was an older FFEL loan, a commercial loan, one that was not commercially held. I had no idea sort of the implications of that or what any of that meant. You see federal Stafford, you think, what, that has no meaning to a borrower. And so, again, that's where just an understanding of an awareness of that is so crucial. And one thing I would just add on the NSLDS report or file, when you download that from the Department of Ed website, it comes in the form, the least usable form possible, classic, sort of a text file. And so it's almost impossible to sometimes sort of decipher and scroll through and read. And so actually the Savvy tool, during that loan sync portion, borrowers actually have the option to upload their NSLDS file if they choose to. And that's another way, instead of syncing their loans, that we can help identify for them and confirm that they have one loan type or another.
Okay. You mentioned in one of the slides about the $10,000 debt forgiveness that Biden is proposing, and somebody wanted to know if that was just for student loans or debt in general.
Yeah, so the $10,000 in student debt cancellation is specifically targeted at student loans. And in reality, a lot of these proposals may likely impact just federal student loans based on the pattern of kind of regulatory limits on private student loans. I think it's worth noting, or at least explaining kind of the way this debt cancellation conversation has unfolded. So on the campaign trail, the president said that he was going to support $10,000 in debt cancellation immediately as COVID-19 relief and stimulus. He also campaigned on top of that, additional debt cancellation that would cover tuition-related debt from public universities. So the president's proposal really started with $10,000, but included much more forgiveness in some limited capacity. What the congressional resolutions say is that we don't need a piece of legislation. The president has legal authority under the Higher Education Act to really cancel all student loan debt if he so pleased. But they've pegged it at $50,000 as a number that's both reasonable and would have the broadest impact for people that are struggling the most. So those two now, those totals, $50,000 and $10,000, are kind of the two front and center proposals when it comes to debt cancellation. But throughout the pandemic, there's been several other proposals at $30,000 in Congress, and so there's a healthy debate. But most advocates on this topic recognize that $10,000 isn't enough for most borrowers. It would, if that were the case, it would be just a starting point, what we're calling a down payment on what would need to be much more relief for those that have more debts or wouldn't be touched by this type of cancellation.
Okay, so there were several questions. One of the things I want to point out really quickly to the folks with Savvy, we had a few people who quickly jumped onto your site through the NHRC link that we provided, and they said they got a message immediately saying that they needed to be careful that this site might be trying to take their information.
So it might be because the link, did you put www.nhrc.bysavvy.com? Sometime when we enter, or when you enter it that way, it goes directly there. Let me, I can put it in the chat, Ellie, the direct link. Here you go. For some reason, the way that you enter it into the browser can impact how that shows up. So here, I will, if it's okay, Ellie, for me to put it in the chat.
Yeah, go ahead. And also just email it to me, because I'll include it in the email we send out with the recording.
Okay.
In our chat, it will show up as a link if I don't put www. Yeah, there you did HTTPS. Yeah.
I was just going to say
I don't understand it, but it's the difference between www and HTTPS. So apologies about that, but hopefully that should work now. You could also just put nhrc.bysavvy.com. Skip the no need to put the HTTP or www, and that'll get you there.
Yeah, it wouldn't have worked to make it a link in the chat box though.
Oh, but yeah, that's true. Well, hopefully that helps. But if they want to type that in, they can do that too. But yeah, thanks for flagging. Sorry about that.
Okay, there's also several questions about the fee structure. So I'm just going to quickly run that through. And if there's anything that I don't have exactly right, please just follow up after I'm done. But essentially, anybody can sign in to bysavvy.com and utilize a certain number of free options through the system, which are pretty significant as you saw in the presentation. If one goes in through the NHRC link, there are still free options available, the same free options available, but the benefit of going in through the NHRC link is that you can then get, if you want to utilize the extended services offered by Savvy, it's at a discounted rate. And that discounted rate is available because you are on our Leaders in Housing Counseling listserv, you're with a housing counseling agency, you're with an organization that does work with consumers, so you get the benefit of that discount. If you're a member of NHRC, we provide you altogether different link that gets you in, and again, there's free services, but additionally, if you or your clients or your family members want to use the additional more in-depth services, then there is a reduced rate of, I think it's around $30 something. We have a slide that gives the exact amount. So that's the fee structure. And the other thing that I want to mention is this is per person. So it's not per agency, and then you can just share it with all of your employees and your clients. It is per person. And the additional thing that Savvy talked about today is if you individually go in and then share it and refer a certain number of people, they get a further reduced rate. So that's new from when we started this last year. So I think that pretty much covers it, unless the folks at Savvy have something to add.
No, that was perfect. And just to clarify one bit there is really if you are working with a number of different people in various different scenarios and cases, they might be using the tool in different ways, and so in some cases Essential might make sense, and in others it might not, and helping them to utilize the free account. My advice would be I encourage everyone to sort of at least create that account and utilize and take advantage of the free tool as much as possible in its ability to identify those particular plans and savings. And one other thing is, as a registered user with that free account, you're going to receive, sort of the latest and breaking policy announcements on the student loan front. And so when Biden, issued that executive order back in January on his inauguration day, within an hour of that announcement of the payment extension, all of our users were aware and able to set up follow-up meetings and attend webinars about how that impacted their student loans. Servicers still have yet to communicate about the payment suspension with their borrowers. I haven't heard a peep from Navient. So just even the benefits of that free account as far as visibility around what's going on these days can be really beneficial.
Great. Somebody is asking the question for the loan sync that you showed. Is the login being used the FSA ID?
No, it is their servicer account, whatever that may be, Navient, FedLoan, whatever. It's that username and password credentials.
Great. Okay. What's the name of the form again that the employers need to sign off on?
It's called the Public Service Loan Forgiveness, or Pslf, Employment Certification Form, and I can put it in the chat box as well.
Okay. Any chance, if somebody's already paid off their loan, that there's a retroactive reimbursement of funds?
Not that I'm aware of. Cody, Natalia can confirm this. Unfortunately, no.
Not that I'm aware of. And then also, so I'm one of the lucky ones that have actually paid off my loan, but I was a borrower before, 2010. I had a FFEL loan, so I don't. When there was only a few that even qualified to begin with public service loan forgiveness, I don't think there's many folks out there that actually did that, if that makes sense.
Okay, somebody's asking, when will the Fed loan servicing count the pandemic suspended payments for PSLF? My last research last fall, they did not include those.
So if I'm understanding it correctly, the borrower recertified last fall and is saying essentially that those months of payment suspension were not included.
That's what it sounds like.
Okay. Yeah, it's hard to say. We definitely want to look into the case further with you or that borrower. The one thing I can take a stab at here that could be the case is that perhaps you were not on an eligible repayment plan during that time. So even though payments were paused, borrowers still needed to be technically on an income-driven repayment plan in order to have that non-payment count. If you had fallen out of your previous, repayment plan or didn't recertify or was in a standard plan or another plan, that could be the reason why. But again, we're happy to help. That's why we're here to look into that case and follow up with Fed Loan directly to see why that's the case.
Okay, and the last question that I'll oh no, wait, no. Do the 3 referrals need to actually sign up to get the 50% discount, or do we just make the referrals and that is enough to qualify for half off?
Nope, you just make the referrals and that's enough to qualify.
All right, great. And then the last question I'll ask, this is not specific about Savvy or federal student loans, but there was some information that you all provided about the National Association of Realtors numbers about Black home ownership, and one person as a Hispanic asked if Hispanic homeowners were included in that number or if they were left out, and just commented that that seems to be happening a lot.
Yeah, we have, yeah, go ahead, Cody.
Well, I was going to say, for this particular report from the National Association of Realtors, there was some information and data that looked at both Latin homeowners and Asian American homeowners as well. So there was some other data points, and I'm happy to share that link in the chat as well. I think for the purposes of the very obvious disproportionate impact for Black borrowers, the report focused really in on that impact. But we know people of color from many different backgrounds and communities are impacted by student debt in ways that are different than their white peers. Natalia, feel free to jump in. I didn't mean to cut you off, but this area is really important right now in this moment.
Yeah, and I was just going to say, to the questioner, we've heard that same type of feeling. I will say in the student debt space, we know that Unidos US, a great organization working for Latino Americans, has been working on the issue of student debt. I think we need to encourage a lot more data and research for all groups in this space. It's very helpful, and it is on, what we're hearing from our kind of positive meetings with White House and other lawmakers is that the equity argument is going to be what helps us pass a lot of legislation, at least right now and during this time.
Great. And Cody, if you would also send me that link in email, because again, it's another link I'll include when I send out the recording to everybody.
Sure, not a problem.
And that is the last question. Thank you.
Excellent.
Thank you so much.
Great. Thanks so much, everybody. Terrific. So quickly to wind up, so here's the membership plug. We've actually had a very good year already. Really appreciate all the groups that have renewed, and we've gotten a couple new memberships. You'll be able to get the Savvy discount, and I didn't know about that. With 3 referrals, it gets reduced to $15. So that's great as well. Please spread the word, and it's available to your clients as well. And then we still have the credit report with discount with CoreLogic Credco, and looks like the price is holding this year. I'm glad to see that, and we are doing a hefty amount of business through that. So glad to, if your organization's a member and not accessing this, you really should take advantage of it if it provides a savings for you. And that's the price for tri-merged, but we can send you the pricing schedule for groups that use one or two credit bureaus. And with that quick note, we're planning a call in 2 weeks because you don't have a guest yet, so that's a little bit tentative. Just watch the leaders call for the next scheduled one. We'll post well before that. And thanks everybody for your participation.